So welcome to today's class. We want to have a short class, but we finish everything that we were meant to do. So we were on the topic standard costing. So we had seen that a standard is a planned unit cost of a product or a service. And then we looked at what we call standard cost card. Now, after covering the standard cost card, we also now looked at variance analysis. Under variance analysis, we saw that in variance analysis, variance is the difference between budgeted and actual results. Differences between budgeted and actual results. That is what gives you a variance. Now, next, we also saw that variances can either be favorable or adverse. Favorable is abbreviated with the letter F or FAV. Adverse is abbreviated with the letter A or ADV. So variances can either be favorable or adverse. Now we said favorable arises when the actual performance is better than budgeted. So favorable is when the actual results are better than what was budgeted. So when you find that the actual results are better than the budgeted results, it is favorable. On the other hand, when you find that the actual results are worse, are not good compared to budgeted, it becomes adverse. So we said that for costs are expenses, what you spend on. Favorable arises when actual costs are less than budgeted costs. So when we are looking at costs are favorable when actual costs are less than budgeted costs. And costs are adverse when actual costs are more than budgeted costs. We saw that for income, for example, sales is favorable when actual sales is more than budgeted. So when you find that your actual sales is more than your budgeted sales, it is favorable. Now we looked at what causes a variance. We saw that causes of variance can be either change in prices or change in quantity, or even both changes in prices and changes in quantity. We looked at factors to consider before investigating a variance. Let me not go deep into this. We talked of materiality, controllability, interdependence between the variances, cost of investigation, and the type of the standard that had been set. And then next, we now looked at types of variances. Under types of variances, note that we have sales variance. Sales variance is equals to, sales variance has got two variances in it. There is sales price variance and there is sales volume. The second type of variance is called material variance. There is material price and there is material usage. The third type of variance is labor variance. There is labor rate variance and there is labor efficiency variance. The fourth type of variance is variable overhead variance. So there is variable overhead expenditure. How do you write expenditure? Expenditure variance and variable overhead efficiency variance. Next, there is fixed overhead variance. Now, fixed overhead variance, they are of two types. There is fixed overhead expenditure and there is fixed overhead volume variance. Now, we say that volume variance only exists under absorption costing. So under absorption costing. Under marginal costing, there is no fixed overhead volume variance. So under marginal costing, there is no fixed overhead volume variance. There is no fixed overhead volume variance. Next, fixed overhead volume variance is subdivided into two. There is fixed overhead volume efficiency and there is fixed overhead volume capacity. Now, we also saw that how do we get there? Fixed over, okay, I've said fixed overhead volume and fixed overhead capacity. So fixed overhead volume efficiency and then we looked at the many formulas that we learned last time now. We said the first formula is sales price variance. How do we calculate sales price variance? Budgeted price per unit minus actual price per unit times actual quantity in units times actual quantity in units. There was sales volume variance. Sales volume variance depends on whether you are using marginal costing or absorption costing. It depends on whether you are using marginal costing or you are using absorption costing. Now, if you are using absorption costing, the formula is budgeted quantity minus actual quantity times budgeted profit. You can see what is in red, times budgeted profit per unit. So profit per unit is used under absorption costing. Under marginal costing, the formula changes. Budgeted quantity remains the same. Actual quantity remains the same, but what changes is now this budgeted contribution per unit. Remember, how do we calculate contribution per unit? Contribution per unit is selling price per unit minus variable cost per unit. Selling price per unit minus variable cost per unit. So how do you get total sales variance? When you take sales price variance plus sales volume variance, what you get is total sales variance. So what you get there is total sales variance. So next, we looked at, after sales variance, we looked at material variance. We said there are two types of material variances. There is material price variance and there is material usage variance. How do we get material price variance? Material price variance is budgeted price per kg minus actual price per kg. Budgeted price per kg minus actual price per kg times actual quantity in kgs times actual quantity in kgs. So material price variance is budgeted price per kg minus actual price per kg times actual quantity in kgs. Material usage. Material usage variance, the formula is budgeted quantity for actual production minus actual quantity times budgeted price per kg. So how do we get this one? How do we get this budgeted quantity for actual production? So maybe I can write it there. Budgeted quantity for actual production is equals to budgeted quantity per unit times actual production units times actual production units. That is what gives you BQAP. Budgeted quantity for actual, this one here, this one here. How do you get it? It is budgeted quantity per unit times actual production units times actual production units. And then, of course, that leads us to total material variance. Total material variance is material price variance plus material usage variance. Labor was the next type of variance. So under labor, there is labor rate variance and there is labor efficiency variance. Labor rate variance and labor efficiency. Now, labor rate is the budgeted rate per hour minus actual rate per hour times actual hours. I'm repeating, budgeted rate per hour minus actual rate per hour times actual hours times actual hours. There is also labor efficiency. Under labor efficiency, the formula is budgeted hours for actual production minus actual hours times budgeted rate per hour. How do you get these budgeted hours? How do you get the budgeted hours for actual production? How do you get the for actual production is equals to budgeted hours per unit times actual production units times actual production units. That is what gives you that budgeted hours for actual production. So if you want to get the budgeted hours for actual production, it is budgeted hours per unit times actual production units times actual production units. So when you add these two variances, labor rate plus labor efficiency, that gives you total labor variance. It gives you the total labor variance, the total labor variance. Next, there is variable overhead expenditure variance. Variable overhead expenditure variance. Now, how do we get the variable overhead expenditure variance? The formula is the same as labor rate. The formula for variable overhead expenditure is the same as the formula for labor rate. So what is the formula for labor rate? Budgeted rate per hour, you can see it there, minus actual rate per hour times actual hours. Budgeted rate per hour minus actual rate per hour times actual hours. Next, we have variable overhead efficiency variance. Again, the formula is the same as labor efficiency. Variable overhead efficiency, the formula is the same as labor efficiency. So let me skip that. Finally, the last category of variances is fixed overhead variances. Under fixed overhead variances, the first one is fixed overhead expenditure variance, and the next one is fixed overhead volume. So this is fairly straightforward. Fixed overhead expenditure variance, the formula is budgeted fixed overhead costs minus actual fixed overhead costs. Budgeted fixed overhead costs minus actual fixed overhead costs. How do we get fixed overhead volume? So fixed overhead volume, it is budgeted production units minus actual production units. I'm repeating, budgeted production units minus actual production units times budgeted fixed cost per unit times budgeted fixed cost per unit. So we said that this volume variance is only there under absorption costing. It is only there under absorption costing. And then there is fixed overhead volume is subdivided into two. Is subdivided into two. So you can see the word volume there. So there is the word volume there. There is also the word volume there. So don't confuse that. So there is volume efficiency. So there is volume efficiency and there is volume capacity. So take note of that. So we have fixed overhead volume efficiency and fixed overhead volume capacity. How do we get the efficiency? Efficiency is total budgeted. This was units. Now this is total budgeted hours minus total actual hours times fixed cost per hour. On the capacity is budgeted hours for actual production. Everyone now knows how to calculate this. Minus actual hours times budgeted fixed cost per unit. Now, please understand that if you take the capacity plus efficiency, what it gives you is volume. When you take capacity or efficiency plus capacity, what you get is volume. Now, before we go to an example, How do you know that your variances is right? How do you know that your variances are right? Variances are normally reconciled by preparing what we call operating statement. So you only reconcile your variances by preparing an operating statement. Operating what? Statement. Let me call it OS. Operating statement. So we can say variances are so this one we did not cover last time. Variances are reconciled by preparation of an operating statement using either marginal marginal costing. So marginal costing is normally called MC, or absorption costing, by using either marginal costing or absorption costing. So variances are reconciled by preparing an operating statement. So variances are reconciled by preparing an operating statement. So that is the first point. Variances are reconciled by preparing an operating statement. Now this operating statement is prepared using either marginal costing or absorption costing. So we can say operating statement starts with budgeted profits. How do you write budgeted? Budgeted profits and ends with actual profits. So operating statement normally starts with budgeted profits. It starts with budgeted profits, and it ends with actual profits. So if variances are correct, are all correct, budgeted, if are all correct, comma, budgeted profits plus all favorable variances, comma, minus all adverse variances will be equal to actual profits. Take note of that. That is very important. If variances are correct, budgeted profits, that is budgeted profits, plus all favorable variances minus all adverse variances will be equal to actual profits, will be equal to actual profits, will be equal to actual profits. So will be equal to actual profits. I hope we are together there. Now, here, remember operating statement, there are two operating statements, either using AC or, so remember, so let me have NB. There are two what? Operating statements using either AC or what? MC. Using either AC or MC. So next we want to look at format of operating statements. Formats of operating statements are as shown in the next slide. They are as shown in the next slide. So the format are as shown in the next slide. So the format are as presented in the next slide. So let's go to the next slide. Now, we'll start with AC operating statement. AC operating statement. AC operating statement. So I can have something like this, maybe 4 columns, and I can have as many columns as possible here. As many columns as possible. So we can have something like that to show you how the statement looks like. So we are starting with AC operating statement. AC operating statement. Now in our AC operating statement, let me increase that a bit. That is too big. So in our AC operating statement, if I have here everything in the middle, you start with, what did we say? An AC operating statement starts with budgeted profits. You start with, sorry, let me change the font. So AC operating statement normally starts with budgeted profit, budgeted profit, which is of course budgeted profit per what? Per unit times budgeted units. Budgeted units times budgeted units. You post your figure there. Budgeted units, you post your answer there. Next you account for sales price variance. Sales price variance. So sales price variance, if positive, you add. Sorry, if favorable, you add. If adverse, you less. So if adverse, you less. So if favorable, you add. If adverse, you less. If favorable, you add. If adverse, you less. So we have something like that. So remember, if F add, if add F, sorry, what are we saying? If F, what are we saying? Add. If A, what do? You less. So if A, you less. So we've already said that, and I don't now need to read. So next, sales volume variance. There are two sales volume variance. There is the one using profit, using what? Budgeted profit per unit, because we are under AC. So the one using budgeted profit per unit, because we are under absorption costing. So if positive, you add. If negative, you less. If negative, you less. If positive, you add, and then you get the total of this. You get the total. So if positive, if favorable, you add. And then next, now you go to what we call cost variances. You go and list all your cost variances. So our cost variances, if it is F, you write it there. Favorable. If adverse, you post it there. So it can either be favorable or it can be adverse. Can be favorable or it can be adverse. Now you start with materials price variance. Let's assume it is F. I'm just guessing. I don't know. It can be F or it can be A. So let's assume it is F. So if it is F, you'll post it there. So there is nothing for A. Next, materials usage variance. Materials usage variance. So material usage variance. So under material usage variance, let's assume it is A. So if it is A, you know where you will post it. you'll post it under that column. You'll post it under that column. Next, labor rate variance. Labor rate variance. Let's assume it is F. I'm just guessing those values. You post it there. If it is A, you post it there. Next, labor efficiency variance. Labor efficiency variance. Let's assume it is A. So if it is A, you know the column where to post it. Next, variable overhead expenditure variance. Variable overhead expenditure, let's assume it is F. Variable overhead expenditure variance, if we assume it is that. Next, variable overhead efficiency variance. Let's assume it is A. Variable overhead efficiency variance. Let's assume it is A. Next, fixed overhead expenditure variance. Fixed overhead expenditure variance. We have F. Next, fixed overhead volume variance. So let me write it in short. Fixed overhead volume variance. Let's assume it is A. So this one only under AC. Only under AC. This one is there only under AC. So this variance is only there under AC. So don't confuse that. So again, let us assume it is A. We post it there. Now, and then next, you get the total of your F's and the A's. You get your total there. You get the total of those cost variances. And then you get the difference between F and A. If the difference is F, you add it. If the difference is A, you less it. I'm repeating. You get the difference between this value and that value there. So if the difference is F, you add it to this answer. If it is A, you less it from that answer. Now the answer you get, the answer that you get when you do that is what gives you what? Actual profit. Actual profit. So the answer you get gives you actual profit. And this is what is used to confirm whether your variances are all correct or whether there is a problem somewhere in one of the variances. That is called AC operating statement. 2 minutes to understand that before we go to MC. 2 minutes. Take note of what I have put in red. Take note of what I have put in red. Okay. So, okay, I didn't mean 2 minutes. I meant 30 seconds. Okay, so let's move on. That is under AC. So why don't we look at MC? How does MC look like? How does MC look like? So I'll duplicate the same. And then now I'll just change these to MC operating. So let me put this in red so that you know the differences in the statement. So here it is in red. So, okay, so if it is MC now. Here we don't use profit per unit. Here we use contribution. We use contribution. Contribution per unit. Contribution, we use contribution per unit. Now, here again, there is no fixed overhead volume. Take note of that. There is no fixed overhead volume. So, there is no fixed overhead volume variance under what? Under MC. So there is no fixed overhead volume variance under MC. So there is no fixed overhead volume variance. It is not there under MC. So our objective for the next 1 hour that we are remaining with, what will we be doing in the next 1 hour? Will be in the next 1 hour, what we'll be doing, we'll be calculating the variances. Once we have finished calculating, we prepare an operating statement. So let's go to our Excel sheet unless there is a question. So here we use contribution. Okay. So next, so let's go to our Excel sheets. I hope I have it. Now, take note of this question. Take note of this question. It's an important one. So take note of this question. The question reads, ABC Limited produces and sells one product only. The standard cost card and price for 1 unit being as follows. Please take note of this, understand it, because I'll only do one example and I'll give you another example to do on your own. So take note of this. I will do one example, but I will give you the other example to do on your own. So ABC Limited produces and sells one product only. The standard cost and price for 1 unit being as follows. The standard cost and price for 1 unit being as follows. The standard cost and price for 1 unit being as follows. So we have direct materials, per unit. Remember, this is cost per unit. Cost per unit standard. Standard is the same as budgeted. So direct materials, it's 10 kgs at $12 per kg to give you $120 per unit. Direct, so we have 2 types of materials. Next, we have wages. We have fixed. We don't have any variable. You see, after labor, we are going to fixed. There is no variable. So in this question, variable is 0. Take note of the following statement. The fixed production overhead cost included in the standard cost is based on a monthly output of 750. Is based on an expected monthly output of, so this is the budgeted production and sales units. That is the budgeted production and sales units. Next, you are being told during April. Remember, April is a month. April is a month. So during April, actual results were as follows. During April, actual results were as follows. During April, actual results were as follows. So what are our results? We have results are sales. Remember, these are for the whole month. Actual sales was 750 units at a selling price of 320 to give you a total cost of sales of 224. So direct materials for the month of April, there was 7,500 kgs, etc. We go until down. So you are being told ABC Limited does not hold any inventories. Calculate all appropriate variances, and number 2, prepare an operating statement. So calculate all appropriate variances, and number 2, prepare an operating statement. But I want to start with an operating statement. So AC operating statement. So let me start with the statement. So you all know that in our statement, what do we start with? In our statement, we are assuming everything is in Rwandese or dollars, Rwandese francs. So what did we say you start with? You start with budgeted profit. Take note of what I'm doing carefully. So AC, you start with budgeted profit. Now you can see the budgeted profit in the question. So remember, the profit is, standard gross profit is 50. So that is 50 times 750 units. So remember, 50 is the profit per what? Per unit. Profit per unit. Profit per unit. So what do we get if somebody can get me that? So that is equals to 50 times 750 is the budgeted production units and sales units. So we have that. Just excuse me. Okay, so we have budgeted. So next we said you account for sales price variance. We will have working one. Next, sales volume variance. We will have working two. Next, we'll have, you'll get the total. So you'll get the total of that. And then next, you'll go to cost variances. Cost variances. I'm just following the format we learned so that when I start calculating, when I calculate, I come and post. Cost variances, we said this column will be for favorable. This column will be for adverse. Favorable and adverse. So next, we have material price variance. Material price variance. Working 3. There are two types of materials. So there is material A. Material A, let me call it material A. So I'll call it working 3A. So working 3A. So next, material price variance. Variance for which B. So I'll call it working 3B. We'll have that working. Next, material usage. Please note down that variance for material A. So that will be working for part A. Next, material usage variance for B. So that will be working for B. Next, labor rate variance. Labor rate variance working 5. Working 5. Next, we have labor efficiency variance working 6. Next, we have variable overhead expenditure variance. In this case question, we did not have it. So we don't have any working for that. It was not there. So it is not there. There is no figure there. Sorry, it is 0. So I think 0 is easier to write. So it is 0. Next, we have variable. In another question, it will be there. Overhead efficiency variance. So in this case, again, it is not there. It is 0. It is 0 because we were not given in the question. You see, there is nothing written as variable. It is materials, labor, fixed. There is no next. Fixed overhead. fixed overhead expenditure variance, fixed overhead expenditure variance working 7. Next, fixed overhead volume variance. Always picture this format, working 8. So we have all the variances that we need there, working 8. So you will get your answer, and then now you get the total cost variances. Total cost what? Variances. So you get your total cost variances. Total cost variances. You come and get the total of these. And you also come and get it down there. The total of that. You come and get it. And then you get the answer there. Now the difference becomes what is called actual profit. You already know the actual profit. You are always given. So if your variances are right, please understand me. If you start with 37 and all your variances are right, you will end with 47. You see this 47 here? That is what you will end with. This 47 there, it is given. So it is always what? Given. So if you don't get that, you know you are wrong somewhere. If you fail to get this, you know one of your variances was a mistake. That is which type of variance? That is operating statement. Sorry, not variance, operating statement. So that is an operating statement using which method? In that case, we are using a method called what? AC. We are using a method called AC. Now, besides that, I will also have another column, but for MC, so that when I finish, immediately I finish, I can do both. So I'll also have for MC. I'll come and post including my formulas so that everything so we have that. So actual here. So what is the actual? Actual is still that 47. So the actual is still, so remember that I've just posted the same. So what is the difference? Here, the sales volume variance that is used, here the one that is used is the one using profit. So using profit. Here is the one using contribution. So don't forget that, using contribution. So this one is MC. So that is the first difference. The first difference is there. The second difference is here. So under marginal costing, there is no this variance. So there is no fixed overhead. There is no fixed overhead. There is no fixed overhead what? Volume variance under MC. So there is no fixed overhead volume variance. There is no fixed overhead volume variance under MC. So that is not there. It is 0. There is no fixed overhead volume variance. It is 0. That is also 0. So we have our template. So what is now remaining is just to go and calculate each variance. Every variance you have calculated, you post it. Every variance calculated, your work is just now to post it. Somebody's asking me why material price variance is twice. Look at the question. There were 2 types of materials, material A and material B. Have I answered you? If you've understood, type yes so that we continue. So we want to go to the workings. So we want to go to the workings, and we calculate the first working is sales price variance. The first working is sales price variance. Sales price variance. The first working is sales price variance. Now, how do you get the sales price? How do you get the sales price variance in this case? Sales price variance here in our workings. So number one, working one is sales price variance. Sales price variance, the formula, if you can remember, sales price variance is equals to, what did we say? Budgeted price per unit minus actual price per unit times actual quantity in units. That is the formula we learned. So let's apply the formula. Sales price variance, please let's be very careful here, is equals to what is the budgeted price, the standard price per unit. The standard selling price, you can see here, is 300. So it is 300 per unit minus actual selling price. Actual selling price, you can see here, during the actual results were 320 per unit. So you can see there 320 per unit. I hope everyone sees that. Times actual quantity is 700. So outside the bracket, you multiply by 700. So maybe somebody can give me the answer. So the answer is, you always start with the one that is more. The one that is more is 320. 320 minus, you start with the one that is more, times 700. So what do we get? 14,000. So let's look at my reasoning. We had budgeted to sell this product at 300. We actually sold at 320. Did we gain or did we lose? We had budgeted to sell at 300. We actually sold at 320. Did we gain or did we lose? You can type for me. Is it favorable? If you gain, it is favorable. If you lose, it is adverse. You can type for me. If you favorable. So it is favorable. Thank you. So you come and write there F. So if it is favorable, you write F. Which variance is that? That is which variance? Sales price variance. So I'll come and post it there. Sales price variance. Working one. Sales price variance is 14. So it is F. So if it is F, what do? You add. Why do you add? Because it is F. So it is F, you add. Let us continue. Sales volume variance, we are under AC. So let's go to working two. Working two, sales volume variance. Sales volume variance. So under our sales volume variance, we will start with A under, or number one, under absorption costing. Absorption costing. So under absorption costing, AC. So under absorption costing, the formula is sales volume variance is equals to budgeted quantity minus actual quantity times budgeted profit per unit. Per what? Unit. Times budgeted profit per unit. So here, times budgeted profit per unit. So in this case, look at what I'm doing. Sales volume variance is equals to, what is our budgeted quantity? It is still there. It is 750. You can see 750 is the budgeted. So in this case, 750 is what we budgeted to sell, minus 700 is what we actually sold, times budgeted profit. Budgeted profit was how much? 50. You can see 50. 50. Budgeted profit is 50. So times what? 50. So somebody to give me the answer there. You always start with the higher. So the highest is 750 minus 700 times 50. So F or A? F or A? We had budgeted to sell 750. We actually sold 700. Did we gain or we lost? We had budgeted. You reason with what? Remember, this I had explained in the last class. How is it favorable and how is it adverse? We had budgeted to sell 750 units, but we actually sold 700. We sold less. We sold less than we budgeted. So it is what? Adverse, because we lost. We sold less. Sales is income. So we sold what? Less. That is sales under that. Under absorption costing. So we lost. Ellie, I didn't say, remember in variances, you don't look at the positive or negative. You get the difference between the largest. You start with the largest. 750 is the largest, 700. You are not interested in whether it is positive or negative. You just get the difference. Ellie, you just get the difference. You don't take 300 minus that. You just get the difference between the two. Whether it is positive or negative, you ignore. You just reason, you compare what was budgeted to what was actually incurred. So in this case, I hope, Ellie, we are together. You ignore the positives. Thank you. It's an absolute value. So you ignore the positives and the negatives. Okay. Number 2, we have under marginal costing. Under marginal costing. Okay, so under marginal costing, in this case, sales volume variance is equals to budgeted quantity minus actual quantity times budgeted contribution per what? Unit. Budgeted contribution per unit. Remember, budgeted contribution per unit is equals to budgeted price per unit minus budgeted variable cost per unit, which is equals to, what is the budgeted price per unit? Budgeted price per unit is 300. So which is equals to 300 minus variable cost. Variable cost we have budgeted is 120 plus 30 plus 40. 120, 60 is fixed. Don't pick 60. 60 is fixed. So 120 plus 30 plus 40. So 120 plus 30 plus 40. So what do we get? So budgeted contribution per unit is therefore equals to 300 minus, this is 150, 190 minus 190, which is equals to 300 minus 190 gives you what? 110. So next we can get now the formula. Now we can apply the formula. I can now copy and bring that there now. So sales volume variance is equals to budgeted quantity remains the same, 750, minus actual quantity remains as 700 times 110. Whatever you get, times 110. So you take absolute figure, 750, 750 minus 700, close the bracket, times 110. What do you get? 5,500. We had budgeted again to sell 750. We sold 700. So in that case, what do we get? We get adverse. So that is which variance? That is which type of variance? That is sales volume variance. So again, we have that and we have that. So don't forget about that. So that is sales volume. So under, remember this is under AC. That is under AC. This is under MC. So under AC, it is here. So it is negative. Negative. So here it is negative. So you less what? The adverse. I will less it. Let me just post it the way it is. I will come and less it. So sales volume variance here. Where is it? That. So I will come and less it as we continue. So we have 37 plus 14 minus 25. We are preparing the operating statement as we continue. So that gives you how much? 49,000. We have finished with the first part. Now we go to the cost variances. To the cost variances. Now this we can also complete this one also because we already know the answers. Working one is still that 14,000. But now using, you less what? You less A. This you add what? F. If it is F, you add. If it is A, you less. So the one using contribution is how much? 5,500. So using contribution, this statement using contribution is 5,500, but you less. So you less. Remember you less. So it's equals to 37 plus 14 minus 55. So what do you get? 46. So you remember under AC, this is 49. Under MC, this is 46. So you see there are different values. So let's continue. So we are done with the sales variance. So let's go to next, working 3. Working 3. So working 3 is material price variance. Material price variance. Material price variance. So remember material price variance, we have said material price variance is equals to budgeted price per kg minus actual price per kg times actual quantity in kgs. So we have part A, material A. Material what? A. And then we'll also do the same for material B. So let's start with material A. Material price, maybe because there are a number of items we'll be calculating, let's get what is the budgeted price per kg. The budgeted price per kg is equals to, we can look for it, it was given somewhere. Budgeted price per kg for material A is 12. You can see 12 per kg. So I'm just writing it here so that we get it. So this is what? 12. Next, actual price per kg. Actual price for 1 kg is equals to, this one we'll have to calculate. Actual price per kg of material A. It is 91,500 divided by 7,500. 91,500 is for 7,500 kgs. So 91,500 divided by 7,500. 91,500 divided by 7,000 what? 500 kgs. So what do we get? This one will be equals to 91,500 divided by 7,000 what? 500. What do we get? 12.2. 12.2. So we already have next, what is the actual quantity? The actual quantity is 7,500 kgs. Actual quantity is 7,500 what? Kgs. Now we can get the answer now. Material price variance is therefore equals to budgeted price is 12 minus actual price is 12.2 times actual quantity is 7,500. So you can see we are in a position to get the answer. So what is our answer? Our answer there is equals to 12.2. We take absolute minus 12 times 7,500. What do we get? 1,500. We get 1,500. Now, let's reason. Materials is a cost. Cost is expenditure. We had budgeted to buy materials at $12 per kg. We actually bought, buying is spending. We actually bought at 12.2. Did we gain or we lost? These are now costs, not income. Costs. Did we gain or we lost? You can type for me the answer. We lost. So if you lose, it becomes what? Adverse. So if you lose, it becomes adverse. So that is for material A. That is for material A. Let us also do the same for material B. Material B. What about for material B? We get the same. What is material B? Again, we are finding what is the budgeted price per kg for material B. I'll start by finding the budgeted price per kg of material B. Budgeted price per kg is 5. You can all see 5 here. 5. It is 5. So I'll place it there. Is 5. Next, we get actual price per kg. Actual price per kg, we calculate it. Material B, 2,300 divided by 3,500. 2,300 divided by 3,000 what? 500 kgs. So what do we get? Is equals to 2,300 divided by 3,500. So what do we get? If we round off, 5.8. We get 5.8. Next, what is the actual quantity? Actual quantity for this material. Actual quantity for material B. Material B, actual quantity you can see is 3,500. So 3,500. So we can get the material price variance, therefore. Material price variance will therefore be equals to budgeted price is 5 minus 5.8 times 3,500. You get your answer. So absolute again, 5.8 minus 5. Of course, I'll multiply by 3,500. I'll get the answer. 2,800. 2,000. Ellie, there is a difference between costs and income. These are costs. Costs means expenditure. Expenditure. Spending. Spending. We had budgeted to spend 12. We actually spent 12.2. Spending is money going out. We actually spent 12.2. We actually spent 12.2. So in this case, we lost because we spent more than budgeted. We spent more than we had budgeted. We actually spent more than we had budgeted. I hope Eli, we are together. You can type yes so that we continue. Okay, so there is a reasoning of revenue and there is a reasoning for expenditure. The reasoning is different for revenue. Where did 5.8 come from? It is from here. 2300 actual price per kg. 2300 divided by 2300. This one here. Here. Actual cost of materials was 2300 for how many kgs? 3500 kgs. So when you take this divide by that, it gives you the actual price per kg. It gives you the actual price per kg. So here we have, there we have what? A or F? I believe it is A. I hope everyone is seeing the A. Because we spent more than what we had budgeted for. So it is A. That is again material price variance. So we can go and post them. So that is under material price variances for the two, A and for B. So we can go and post them. Material price variance for A, it was A, adverse 1,500. So I'll put it in the column of adverse. So it will be, you can see 1,500. For B is also adverse. So is also 2,000. So for B is 2,800 also. It is also adverse. So we are done with material price. The same can be repeated here because there is no difference. The same is repeated there. The same is repeated there. So we repeat the same. So let's go next to material usage. Material usage for both A and B. So let's go to number working, is it for? Working for material what? Material usage variance. Working for is material usage variance. We said material usage variance is equals to, those who can remember, budgeted quantity for actual production minus actual quantity times budgeted price per kg. Per kg. Budgeted price. Remember, not profit, price. So we will start with material A. We will start with number one. We will start with material A. Material A. So let's start with material A. So let's get the BQAP. So let's get the BQAP. BQAP, we said, is equals to budgeted quantity per unit. Budgeted quantity per unit times actual production units. Actual production units. So what does this give you? So what does it give you? So this gives you budgeted quantity per unit. Budgeted quantity per unit, I saw it somewhere. No, it's not there. Budgeted quantity per unit, let's go back to the question. Budgeted quantity per unit of A is 10 kgs. 10 kgs times actual production units is 700. So 10 kgs times actual production. So look at this. It is 10 kgs times actual production is 700 units. So whatever you get, what do you get? Is equals to 10 times 700 is the actual production units, is 7,000. Next, actual quantity is straightforward. Actual quantity we were given. What is the actual quantity? 7,500. You can see that. 7,500. 7,500. We have that. Next, budgeted price per kg. This one we were also given. What is the budgeted price per kg? 12. You can see 12. It gives you what? 12. So we can therefore get material usage variance is therefore equals to, material usage variance is therefore equals to 7,000 minus 7,500 times 12. What do we get? So is equals to, you take the one that is bigger, minus 7,000 times 12. What do we get? 6,000. So we get 6,000. Look at this. We had budgeted to use 7,000. We actually used 7,500. Did we gain or we lost? Usage. You used more than what you had budgeted. So if you used more than what you had budgeted, it becomes A. You used more than what you had budgeted. It becomes A. It becomes A. You used more than what you had budgeted. The same, we go to material B. Material B. Material B. So let's get BQAP. The budgeted quantity for actual production will therefore be equals to, what is your budgeted quantity? 6 kgs. You can all see 6 kgs there. 6 kgs times 700 is the actual units. So what does it give you? Is equals to 6 times 700. So what does it give you? 4,200. Actual quantity, this one you are given, you don't need to calculate. Actual quantity you are given. So what is our actual quantity? Actual quantity for material B is 3,500. You can see it here, 3,500. So 3,500. What is the budgeted price per kg? Budgeted price per kg of material B. Material B is 5. You can see 5 there. You can see this 5 there. 5. So this gives you material usage variance is therefore equals to 4,200 minus 3,500 times 5. Whatever answer you get. So what does it give you? It gives you 4,200 minus 3,500 times 5. What do you get? 3,500. F or A, we had budgeted to use 4,200. We actually used less, so we gained. You used less, so you gained. So let's get these. We close that. We also close that so that we can post them. So we also close, and then of course the overall is there. So we have that. Now let's post them. Material A, usage is A. Usage is A. Usage is A, 6,000 A. So there are a lot of A's in this question. Usage is A. Material B is F. So material B is what? F. So material B is F. Slowly we are building and continuing. Let's also post here. This is what? A. This is F. So let's continue. So that is material variances. We are done with material variances. That is how we calculate material variances. Working 5. Working 5 is labor rate variance. Working 5 is labor rate variance. How do we calculate labor rate variance? We said labor rate variance is equals to budgeted rate per hour minus actual rate per hour times actual what? Hours. So budgeted rate per hour minus actual rate per hour times actual hours. So what is budgeted rate per hour? Budgeted, I think this one we were given. Let's check. Budgeted rate per hour. Budgeted rate per hour is, were we given labor rate? Yes, 8 per hour. You can see that is 8 per hour. So that is 8 per hour. Actual rate per hour. This one you are not given, you must calculate. Actual rate per hour, it is 27,880 divided by 3,400. 27,880 divided by 3,400. 27,880 divided by 3,000 what? 400. That gives you 3,400 is the hours. So what does that give you? 27,880 divided by 3,400. So what do we get? We get 8.2. 8.2. Now, next, actual hours. Actual hours we were also given. Actual hours we were given. What are our actual hours? 3,400. So actual hours is 3,400 hours. Okay, so 3,004. So are we in a position? Labor rate variance is therefore equals to, budgeted rate per hour is 8 minus 8.2 times 3,400. Somebody to get me that? Is equals to 8.2 minus 8 times 3,400. So what do we get? 680. Now look at this. We had budgeted to pay employees at 8. We actually paid at 8.2. The company therefore lost. Why did we lost? Because we spent more than what we had budgeted. We had budgeted to pay employees at 8. We actually paid them at 8.2. We lost. So that is A. So we come and post it under the A column. Labor rate is A. So I'll come and post labor rate is A. So I'll also transfer the same value to the other side. So labor rate variance is A. Okay, let's continue. So that is labor rate variance. Next, we are slowly finishing. Working 6 is labor efficiency variance. 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 Now, how do we get labor efficiency variance? We said labor efficiency variance is equals to budgeted hours for actual production minus actual hours times budgeted rate per hour. So how do we get budgeted hours for actual production is equals to budgeted hours per unit times actual production units. So that gives you budgeted hours per unit. Budgeted hours per unit times actual production units. Budgeted hours per unit is 5 hours. You can see these 5 hours. So budgeted hours per unit is 5 hours. 5 hours times 700 units. So how much do we get? So is equals to 5 times 700 is the actual production units. Next, actual hours. Our actual hours, everyone knows that it is 3,400. Actual hours, you can see these 3,400. Actual hours is 3,400. What is budgeted rate per hour? Budgeted rate per hour is equals to 8. You can see $8 per hour is equals to 8. So labor efficiency variance is equals to 3,500 minus 3,400 times 8. So what do we get? What we get is equals to 3,500 minus 3,400 everything times 8. So what do we get? 800. Somebody to help me. Is it F or A? We had budgeted to use 3,500 hours. We used less. Is it F or A? F. Thank you. It is F. So this is, sorry. It is F. Why F? We used less hours than budgeted. We used less hours than budgeted. We used less hours than budgeted. So this is F. So labor F is 800. So next, this question did not have any variable. Thank you. We are now understanding it. Okay, let's post F also this side so that when we finish, we just finish all of them together. So this is that. So we did not have any variable. If there is any variable variance, you do it in the same way as labor. If there is, so NB, there are no variable overhead costs in this what? Question. There are no variable overhead costs in this question. There are no, you cannot see anything written variable here. There is no variable overhead in this question. So next number, working 7. Working 7 is fixed overhead expenditure variance. This is normally the easiest of all. Fixed overhead expenditure variance is equals to budgeted fixed overhead expenditure minus actual fixed overhead expenditure. And you get your answer. So we'll start with what is our budgeted fixed overhead expenditure. Expenditure is equals to our budgeted fixed overhead expenditure. Remember, it is 60 per unit times the number of units is 750. So 60 per unit, so is equals to 60 times 750 units. Per unit times 750 units. So what does this give you? It gives you 60 times 750. What do you get? 45,000. What is the actual fixed overhead expenditure? This one is given, you don't need to calculate. What is the actual fixed overhead expenditure? 37,000. You can see the 37,000. 37,000. It is given 37,000. So you can all give me what is the fixed overhead expenditure variance will be equals to 45,000 minus 37,000. So please understand this. We had budgeted 45,000 minus 37,000. We had budgeted to spend 45,000. We actually spent 37. Did we gain or we lost? Help me there. Did we gain or we lost? We had budgeted to spend 45. We actually spent 37. Did we gain or we lost? F or A? F or A? Thank you, thank you, thank you. It is what? F. So you can all see we agree it is F. So fixed overhead expenditure variance is 8,000 F. So I'll come here and post it as 8,000 F. Where is it? 8,000 F. So this is again the same. So this one will be 8,000 what? F. Lastly, we have working 8. Is it working 8? Fixed overhead volume variance. So this one only under AC. Only under AC. Take note of that. Don't forget about that. So fixed overhead volume variance, fixed overhead volume variance is equals to what did we learn? Budgeted production units minus actual production units times budgeted fixed cost per unit. Budgeted fixed cost per unit. So what do we get there? First of all, what is the budgeted production units? Production units. Budgeted production units, I remember it was 750. Actual production units. So let me write it in full. Budgeted production units. Budgeted production units is 750. Next, actual production units. Remember, we have been using it all along, 700. Next, budgeted fixed cost. Budgeted fixed cost per unit. Was it 60? Let me confirm. Was it 60? Yeah, yes, 60. So that was per unit is 60. Okay. Now that is 60. So what is fixed overhead volume variance is equals to 750 minus 700 times 60. What do we get? is equals to 750 minus 700 times 60. Please let us be together here. This one is always confusing. I accept. This one is normally confusing. What you reason is production. Remember, the key word there is production. We had budgeted to produce 750 to produce. We actually produced less. Did we gain or we lost? This is now production. Remember, if you produce more, you gain. If you consume, if you produce less, you lose. So let's reason here. We had budgeted to produce 750. We actually produced 700. Did we gain or we lost? I'm asking again. We gained. Production. Remember, what you produce is what you will. That is why I'm saying this one is always a unique variance. What you produce is what you will sell. Volume of production. Volume of production. You had budgeted to produce 750. Remember, 750 is what you budgeted to produce and sell. You actually produced 700. So it is what? A. Why is it A? I hope you understand. Why is it A? You produced what? Less. You lost. This variance, we said it is only under, what? Absorption. We lost, yeah. It is only under absorption costing. So did we lose? Yes, we lost. So here, there is no variance, there is 0 and 0 because under MC, there is no fixed overhead volume. So let's look at this as we finish. Let's get the total of the Fs. What is the total of the Fs? 3,500 plus 800 plus 8,000. What does it give you? 12,300. Here, that plus that plus that plus that plus that. So what does it give you? That. What is the difference? A is more than F. So we less because it is more. So this minus that, A is more. So look at this. Do we get 47? Look at this. This, because A is more, you less. Why do you less? Because A is more. So you less. So here, what will it be? This minus that. What do we get? 47,320. Is it this? Yes. It means all our variances were right. 47,320. You can see that. 47,320. How did we get it? 49,000 minus this. It gives you 47,320. It means all variance. Let's also confirm this side. Let me remove it first to confirm. So here, look at this. What is the total here? 35 plus 800 plus 8,000. It gives you 12,300. This other side, 15 plus 28 plus 6 plus 680. What do we get? 10,900. Which one is more? F. You add because it is more. F is more. You add. So why do you add? Because F is more. Minus that. Because F is more. So take this plus that. This plus that. What do you get? 47,320. It is the same. 47,320. So regardless of which method you use, you will get the same answer. You will get the same answer. Now, I'm giving you an assignment. Attempt June. Write it down somewhere. Don't prepare an operating statement. Just answer what you have been asked. June 2018, question 6. Write it down somewhere. June 2018, question 6. June 2018, question 6. You can attempt it, and then we will discuss it together. But tomorrow, I want us to go to the longest topic in management accounting. And it is always the most the longest topic in management accounting. It is called process costing. I want us to cover it tomorrow. Process costing. Let's stop there and have a good night. So tomorrow we'll go to process costing. So please, tomorrow, let's all agree to start the class at 5:30. Is 5:30 okay? 5:30? Because it is a Friday class. 5:30. So let's all start the class at 5:30. Are we together? 5:30. 5:30. 5:30. Tomorrow's class is at. I will share these workings in a short while. Friday class should be starting at 4. It is just that because many people leave work late, Friday class should be starting at 4. But we have just decided to at least meet in the middle. 5:30 should be okay. Early. We cannot revise all questions, but during revision, we can revise on one with idle time. It is not very common. I have all past paper questions. It has been tested only twice. So early, it is not very common. Since 2012, it has only been tested twice. Twice is not common. Twice is not common. Twice is not something common. But during revision, we can look at it.